Joining us to talk markets, Alicia Levine, head of investment strategy and equities at BNY Wealth. Good morning to you. We are in the middle of earnings season. Curious sort of what your big takeaway is thus far, and is there anything you're doing about it?
So far, clearly bank earnings are coming in better than expected, both top line and bottom line. Net interest income is better than expected. So that is a good signal for the economy. And I think the other thing that they're showing that our call for the no landing is actually playing out. And that's why you see the stock prices responding to that.
So there is no landing. Forget about soft landing. The plane is not even coming close to the ground.
It doesn't look like there's a landing right now. I mean, it's looking like a very close to 3% quarter for the third quarter, which is essentially 2 quarters in a row of 3%.
Right.
It's no landing. Right.
Pretty good.
And that's the goal, right? The goal was always to get it above 2%. Trend was 2%.
I've been told repeatedly that the economy is horrific. So this is surprising news.
So for part,
I say that somewhat sarcastic.
Well, I know you look for part of the population. It is horrific for those without financial assets. So consumer net worth is up $50 trillion in 4 years since the beginning of COVID, and essentially that's
50, say that again.
$50 trillion.
With a T.
With a T.
Yes.
With a T, which represents a 45% growth where we were before COVID. And that's financial assets, right?
So but that's only 44% of Americans?
That's what I'm saying. So if you own financial assets, whether it's housing or stocks, bonds, other financial assets, you're doing great. Right. You've increased your net worth, and your net interest costs are actually, as a percentage of your income, the same as they were despite the rate hiking cycle. Right. So the spread's higher. So you feel richer, and the percentage of what you're paying to service your debt is the same, unlike the government, by the way.
Yes.
But if you don't own financial assets, it is not the same economy, and you're struggling.
S&P 500, where is it at Christmas, and where is it next Christmas?
So Christmas, we see it at 5,900 into the end of the year.
Okay.
It definitely exceeded our estimates.
Well, we're sort of there.
We're there.
Right now. We're there. Does that mean that we should just go on vacation? At this point, should we just stop, sell everything, and take a holiday?
When the Fed cuts into a soft landing or no landing, which is what we think is happening, if you look back at 6 previous examples of this, on average, the S&P is up 16% in the 12 months, and believe it or not, 44% in the 24-month.
So you think that next Christmas we have even more to go?
Doesn't mean it's a straight line. It's never a straight line. The way inflation's not a straight line on the way down, the market's never a straight line on the way up. We just think that the conditions are such that if you look back in history, the Fed cuts into a soft landing, the market can do quite well.
Can I just ask one final question? The market, or the S&P as we described, is so concentrated today relative to maybe those examples in history. And so the question is, when you're investing, when you say the market, are we just investing in the market writ large, or what would you be doing?
So essentially, the S&P is more or less a tech index, right?
Yes.
We know that, right? And so the U.S. market is essentially a tech index.
Right. And that's different than what it may have been in these, when people look back in history and say, well, 6 times before it was something else.
Yes, but there was always concentration, and there are always large stocks that drove the market.
Okay.
The reason that these stocks continue to stay where they are is because the earnings and the margins are so much higher than any other company in the market. They're just driving the whole thing. So the margins of the S&P are higher. The cash flow is higher. If you go back over 20, 30 years, it's up and to the right in terms of cash flow margins and margins on the S&P. So you can get a higher multiple out of it, which is what we think, which is why we raised our price target into the end of the year.